Hi, I am Shahid, ET certified accountant. On demand of my students, I am going to start a series of lectures, and the first course I am going to start is personal tax. So let me share a screen with you. Give me a minute. So our first chapter is UK tax system. In this chapter, what we will cover is the principles underpinning tax systems, the features of tax systems, how to compare progressive, regressive, and proportional tax system, and the most important topic of residence, domicile, and deemed domicile. The impact that each of these has on the taxation position of a UK taxpayer. Let's start. The first thing, uh, taxation in the UK is administered by HMRC. Yeah. And in UK, um, all individuals have to pay income tax on their total income, national insurance contribution, and employment income. So in UK, we have three types of tax systems. The first type of system is called progressive system. The second one is regressive, and the third one is a proportional taxes. So let me explain you one by one what is progressive system, what is regressive system, and what is proportional tax system. The first one is a progressive system. Under progressive system, if your income goes up, your taxes goes up. So this is a tax system currently in a UK. If your income is lower, you have to pay a less tax. If your income going up, you have to pay a more tax. So that's why there are three bands: basic rate taxpayer, high rate taxpayer, and additional rate taxpayer. Second one is a regressive tax system. Yeah? So under regressive tax system, what happens is it's like the best example is a VAT. Uh, so under regressive system, what happens is if you go on a petrol pump like Tesco, Sainsbury, Asda, wherever, the unpatrolled man shall. So what happens is you have to pay a 20% flat VAT on your petrol. It does not matter if you are rich, if your income is less. So you have to pay a flat rate of 20%. So this is called a regressive tax system where everyone pays the same tax rate, but low income individuals pay a higher proportion of the income in tax than wealthy individuals. And the third one is a proportional tax system. So on proportional tax system is a flat rate tax system. Individual taxpayers pay a set percentage of their income, regardless of total income earned for any size tax base. The UK does not currently have a proportional tax system. So we have seen there are three tax systems in UK: progressive, regressive, and proportional. And the UK, there are two tax systems are using. One is progressive, which one, if your income goes up, your tax rate goes up. And the second one is regressive. We have seen the example of a petrol pump. And the proportional, we don't use in UK. Let's move forward. Tax systems principle. The tax structure of the UK economy depends on its tax base and tax rates. So what is a tax base? So tax base is your taxable income. And tax rate is what is the tax rate set by the HMRC. Let's see an example. Vivian has a taxable income of £1,000. Assume the UK income tax rate is 20%. So tax base in this case is £1,000 and tax rate is 20%. So 20% of 1,000 is 200. And next is tax year. The UK tax year starts from 6th of April to 5th of April. Usually our calendar year start from January to December, but UK tax system start from 6th of April to 5th of April. Let's start an important topic of residence, domicile, and deemed domicile. This is a very important topic. Who is a resident? Who will be called the resident in the UK? Individuals who are resident and domiciled are deemed domiciled in the UK are taxable on their worldwide income and gains, and the individuals who are domiciled are deemed domiciled in the UK regardless of where they are resident are subject to inheritance tax on their worldwide assets. First, see the residents. Who is a resident in the UK? So residence is broadly where an individual is present in the tax year as determined by the set of laws called the statutory residence test. So this test you can run on HMRC website as well, but let me go through briefly with you. So if the person is in the UK for at least 183 days in a year, he will be a resident in the UK. HMRC will look at the individual ties to the UK, say family in the UK, or if they spend more than 90 days there. A UK resident individual is taxable on income received from anywhere in the world. They are also taxable on gains arising from the disposals of assets located anywhere in the world. So residents have to pay a tax on income, from anywhere on the world. Let's see who is a domicile. An individual is domiciled in the country they consider to be their permanent home. An individual can be resident in one country, but if they consider another to be the place where they intend to return once they retire, or where they wish to be buried when they die. So if you want to be buried in another country after you die, so that country will be your domicile, or where you want to, for example, if you want to retire in Spain, not in UK, that will be your domicile country. Individuals acquire a domicile of origin at a birth, which is usually their father's country of domicile. This domicile stays with them until they acquire a domicile of choice. A UK resident individual who is also UK domicile or deemed domicile is taxable on their worldwide income and gains as soon as they arise in the UK. If foreign source income is not examinable in this personal tax unit, if they are not domiciled in the UK, then although they are still taxable on any UK sources income as it arises, they are only taxable on overseas income when they bring it into the UK, known as the remittance basis. The remittance basis of taxation is not available if the deemed domiciles rules apply. For inheritance purposes, UK domiciled or deemed domiciled individuals are subject to inheritance tax in respect of their worldwide asset, whereas non-UK domiciled individuals are only chargeable in respect of their UK located assets. What is deemed domicile? So for deemed domicile, you have to fulfill all of these conditions. There are condition A and condition B. Either these three conditions from A or one condition from B. So what is condition A? If the person was born in UK, have a UK domicile of origin and was resident in the UK for the tax year. So if all these conditions are true, then it means the person has a deemed domicile. Or if all these three conditions are not true, then we will test the condition number 2. He should have to be a UK resident for at least 15 or 20 previous tax years. If the person satisfied any one of these conditions, they will be assessed on their worldwide income and gains as they arise. Similar rules also apply for inheritance tax purposes. So deemed domiciles are chargeable on their worldwide assets in the same way as a UK domiciled individual. Let's see an example of deemed domicile. Karim was born in Liberia and have a Liberian domicile of origin. He moved to the UK and became resident in 2003-4. He has never acquired a UK domicile of choice. For deemed domicile status, Karim must satisfy all of condition A or condition B. Karim does not satisfy condition A, although he is resident in the year he was not born in UK. Because we have studied these three conditions, he should have to be born in the UK because Karim was not born in UK. So this condition is not true even if he fulfill the remaining two conditions. So it means he will not be deemed domicile with the condition A. Although he is resident in the year, he was not born in the UK and does not have a UK domicile of origin. Karim does satisfy condition B because in 2020-21 has been resident in the UK for 16 out of the last 20 tax years. And what was the condition B? Should have to be here for 15 out of 20. So this condition he satisfies. Karim would therefore have a deemed domicile status. Next topic is categories of income. There are a variety of sources that might provide income to an individual, like employment income, property income, bank interest, dividends, self-employment income. Each of these sources of income needs to be categorized correctly in income tax computation. So next chapter when we will start, we will categorize this one. So let me show you an example. John, who is a UK resident, has the following sources of income in the year ended 5th of April 2021. So from employment, he got 32K, rental income is 8,525, bank interest is 800, dividend from UK companies is 900. All of John's income is taxable as it rises as he is UK resident. The sources of income would be categorized as follows. So always this format for all of our course, 8 recommended format, we will use this one. Three categories we will make: non-saving income, saving income, and dividend income. John, we know that from employment income is 32K, rental income is this one, bank interest is this one, dividend income is 900, so total income. So next chapter, we will see the personal allowances and the other stuff as well. So this is just a demonstration what we will do in next chapter. Basis of assessment. When allocating income to a tax year, it is important to understand that there are different bases of assessment depending on the nature of the income. These are summarized in the table below. Type of income and basis of assessment: employment and pension income. The basis of assessment is amounts received in the tax year, including benefits less allowable expenses. Savings and investment income, interest and dividend received in the tax year. Property income, rental income received less allowable expenses paid in this tax year. The cash basis, if property income is less than 150,000, otherwise calculated on an accrual basis. If the property income is more than 150,000, we will use the accrual basis. Trading income, profits from a business, usually calculated on an accrual basis for the accounting period. Exempt income. There are some types of income that are exempt from income tax and are therefore not included in the computation of total income. These include, there are no, so we don't have to include all these one in the calculation of a total income. If in exam you got any of these one, you should not have to include into total income. Interest and dividends from ISAs, interest on national saving and interest certificates, national saving and income premium, bond prizes, lottery, educational grants, damage, damages from personal injury or death. Interest from exempt sources should never be included in the computation of total income. Assessment tip. Exempt income should be identified as such if this is possible in the format of the assessment task. This is the end of our lecture. So I request you to please like this channel, subscribe it, and share with your other friends so other can benefit from this lecture as well. So we will continue our series of our lectures of personal tax. Thank you.